So we'll start with the basics of partnership and trust taxation. So we would be kind of going over the fundamental concepts about the type of entities, the various characteristics of these entities, and the compliance timelines. And at the latter half of the call, we would, keep some time off for any questions or clarifications if anyone may have. So going forward to the agenda, we would be touching base on the different types of legal entity, the comparison for what's the difference between partnership, trust, corporation, breakouts between T5013 and T3 slips, what is the adjusted cost base, return of capital, at-risk amount, which are the technical concepts in terms of determining the cost of your investments in a partnership or trust. We'll also go through, some tax slip considerations for 2024, as well as the alternate minimum tax implications, which will, impact especially trusts in terms of their tax compliances. And we would also go through certain sample ACB, which is adjusted cost base and at-risk amount calculations for partnerships and trusts. Now, moving forward to what are the legal types for tax. Very important to know when is a partnership used as an asset. So basically, partnerships are generally used, especially in the field of financial services. And the reason by which, a lot of investments and assets are done through partnerships in Canada is because of their flow-through characteristics, which means that any income that you earn within the partnership that is distributed to the partners in their proportionate share. So partnerships in Canada do not pay any taxes on their own. So all the income that is earned within that particular entity, that is, let's say it's rental income, interest income, any income from business activity, at the end of the year, after you account for all those incomes, those are distributed to the partners in their proportionate share of investments. And by 31st of March, the partnership has to issue a tax slip, which is known as the T5013 slip. So T5013 slip is also known as a partnership tax slip, and it has all the details of the partner, their share in the partnership, their total proportionate income, the nature of the income that is distributed to the partner. And the partner, after receiving that tax slip, will factor those details in his or her return and compute the tax liability on the income. So specifically in real estate structures, let's say if a group of people want to purchase, let's say a complex or multiple commercial properties, or even say invest in multi-residential properties, if that individual was to invest it in their own name, so the rental incomes would have to be taxed at the highest rate, and they will also be restricted in terms of the expenses that they could claim while reporting rental income, because that expense would only be restricted to, let's say, your maintenance expenses, interest expense, and the like. Similarly, if these assets are held under a corporation, which is the CCPC, the income from real estate or assets is considered to be passive income, and that income will be taxed at the highest rate at 50.17%. Also, let's say if you are investing in multiple properties in your own name, the ability to raise finance would be restricted to your individual capacity, and the title for the property that is held would be in their individual's name. So in the event if there is any default or inability to pay off the debt acquired for real estate, the liabilities would also extend to that individual's personal assets. So what does a partnership do is that if assets are purchased within a partnership structure, the asset is owned by the partnership. At the same time, finance is availed by the partnership. The partnership itself works as an active business entity. Let's say if it's in the business of real estate, it can be construed to be in the business of actively managing real estate. So in that situation, you can earn rental income at the same time, claim deductions for, let's say, property managers or salary expenses taken by individuals who kind of ensure that all the properties are well kept. And the partnership itself does not bear any responsibility of paying taxes, because what the partnership needs to do is compute the income and distribute it to, you know, to all the partners involved. So this is a sample investment fund structure where these entities are used considerably. So if you are making investments, let's say RRSP or registered retirement income plans, you must have seen that, those are invested through a trust. So what does a trust do? A trust, keeps assets on behalf of the beneficiaries, that is the investors, or it could also be a trust for a family where the beneficiaries are children. The assets transferred is of, let's say, the parents, and there is a trustee who manages the assets and generates income out of it. What does a trust do is that whatever income is received by the trust, that is distributed among the beneficiaries, for which a tax slip, which is T3, is issued by the trust. So once again, the trust also does not pay any taxes to the extent it distributes the income that is earned within the entity. But if the trust retains any income, that is, it does not distribute all the income that it earned, then the trust has to pay taxes at the highest rate. Now, for a partnership, you have limited partners and also a general partner. So as per the Ontario Limited Partnership regulation, every partnership needs to have a general partner. So general partner is the partner with unlimited liability, whereas limited partners are people who have limited liability, which means that their liability to pick up losses, if any, is restricted to the amount of capital they have invested. But for unlimited liability partner, which is a general partner, their liabilities are unrestricted. So they may have to, kind of discharge their liabilities also out of assets which are over and above their investments in the partnership. So in a general real estate partnership structure, you generally have a corporation, which is holding a very nominal percentage in the partnership as a general partner, so that that corporation can assume unlimited liability. But because the corporation would have limited assets, so it would not be disadvantageous for the corporation to assume a general partnership status. Now, briefly touching base on explanation. So as I said, partnership is not a separate legal entity. It's a flow-through entity. So you don't file a tax return for a partnership, but you file a tax information return, which is a T5013 return. So partnerships do not pay any taxes on its income, but distribute losses or incomes earned within the partnership. Uh, the financial year end of a partnership is always going to be 31st December. So unlike for corporations, you can decide your tax year end uh, at any time during the year, but for a partnership, it is mandatory to have a 31st December year end, and a partnership tax return has to be filed by 31st of March. In case of a corporation, generally you file 6 months after the year end, but for a partnership, it's 3 months after 31st December, which is 31st March. For trusts, so trusts are treated as separate taxpayers because trusts may be required to pay taxes to the extent they retain incomes. At the same time, any losses which are generated by the assets of the trust has to retain the losses. It cannot distribute the losses. For a partnership, they do not keep any income, nor they keep any losses. So if they made losses, they will distribute the losses to the partners. But the trust will have to retain the losses, and in the future, they can set off those losses against income earned by the trust. Similarly, a trust has to file a trust tax return by 31st of March, and it issues a tax slip in a prescribed form, which is the T3 tax slip. Now, briefly touching upon corporations, which we discussed in the previous session, that corporation is also a separate legal person. It has to file its own tax return. The corporation pays taxes on its taxable income, but the difference between income distributed by a corporation is that, let's say if a corporation is earning business income, interest income, rental income, but when a corporation makes distribution of income, it will make it by way of dividends. So there is a change in the characterization of income that is distributed by corporation, but partnerships and trust would exactly distribute the income in the manner in which they received. There's also a concept of nominee corporations. This is a very common legal concept for real estate. So nominee corporation is a corporation that holds the legal title for the asset, because at many instances, assets are transferred between multiple entities. At the same time, there has to be one specific designated title holder, which is also the bare trustee of the property. So there is also a nominee corporation, which is basically just like any other corporation, but doesn't hold any assets or income. It just holds title, and a nil return is filed for the same. This table provides a brief comparison of all the types of entities. So partnerships, trusts being flow through. Are they flow through for tax losses? Partnership is yes, but no for trust. So trust has to retain its losses. Corporate has to retain its losses. What is the type of income distributed? So partnerships can distribute rental income, business income, capital gains, dividends. So basically, whatever the partnership earns, it distributes in the same manner. For trust, it will distribute other income, cap gains, dividends or foreign income. But for corporations, they would only distribute dividends. Tax slips issued would be T5013, T3, and T5. Due dates for partnerships and trust is 31st of March. For a T5, it's 28th of Feb. And the due date of filing the tax return is 31st of March for partnerships and trust, and 6 months from the year end for corporations. Now, this is a basic sample T5013 slip, which can also be found and downloaded from the CRA's website. So the slip has, different dedicated boxes, which provides breakouts of, different type of incomes. So box 10 shows what is the total number of, the partner's business income. Box 30 shows total cap gain losses. There is also box 104, which provides details of limited partners, business income and loss. Similarly, any distributions made to a partnership, it is reported in box 113, which is also known as return of capital. And there are designated boxes for foreign tax paid and, interest expense, also known as carrying charges. Now coming on to the T3 slip. So T3 slip is issued by trust. It is a relatively simple slip, but it provides breakdowns of if any dividends are distributed by the trust, whether it's eligible or non-eligible dividends. If there are capital gains distributed, they are shown in particular box, which is box 21. There are also, box 26 for other income, and box 42 provides adjustment to the cost base of the asset. So now discussing on ACB, ROC, and ARA. So these are very important tax concepts, particularly when you're dealing with partnerships and trusts. To understand what is the value of your investment in the partnership, how do you calculate it? So let's say myself and Udit start up a new partnership, and both of us put in $100,000 each to kind of invest in, multi-residential real estate. So our initial investment is $100,000. We make income of $10,000, and we had incurred expense of $5,000 for the year. So our net income from the partnership is $5,000. And since we are equal partners, we divide that income, which is $2,500 each, in our equal share. But we do not withdraw cash out of the partnership. So in that case, our total value of the investment in the partnership becomes 100,000, which we initially invested, and 2,500, which was the income that we earned for the partnership. But let's say later, I have some cash requirement and I withdraw $10,000 from the partnership, whereas Udit does not withdraw any funds out of the partnership. So in that situation, my cost base would become 102,500 less 10,000, which I withdraw. So my cost or investment in the asset value would be lower than compared to that, because there was distribution made to me and not to him. So adjusted cost base, as I said, refers to the tax cost. And it's very important. Let's say if the partnership is winding up and the partner has to compute what is his capital gain loss on the sale or dissolution of the partnership. That is when the adjusted cost base comes into effect. Uh, Coming on to return of capital. So any distributions that are made by the partnership to its partner, it is considered to be a return of capital. So return of capital basically is a grind down or a reduction in the total investment of the asset. For trusts, the return of capital is shown in box 42, but for partnerships, any distributions are reported in box 113. Now coming on to at-risk amount. So there is a particular box which is 105, 106 in the partnership slip, which provides details of a at-risk amount. So at-risk amount is the maximum amount of loss that a partner can claim from a partnership. So if a partnership makes significant losses, uh, the limited partner's liability cannot exceed his total value of investments. So the at-risk amount provides the value, which is the maximum loss the partner can bear. If he's allocated losses in excess of that investment, those losses are disallowed to be claimed in the partner's return. Now coming on to 2024 tax slip considerations and other information. So there is the alternate minimum tax regime that has been implemented in 2024. So it is a parallel tax calculation that applies to individuals and trusts and is primarily focused on investment income. There is also disclosure for the excessive interest and finance expense limitations, which is EIFEL rules, which applies to corporations and trust. It limits the amount of interest expense that can be deducted, and a separate disclosure has to be made in those tax boxes. Further, there has been a proposed increase in the capital gain rate inclusion, that is from 50% inclusion to 66.67, which is 2/3. But since the parliament is in prorogation, there are still doubts on how this capital gains rate inclusion will be implemented. But there have been recent communication that has been shared by the CRA that they would provide additional boxes in the partnership slips to split the capital gains which are earned before 25th June, that is at the 1/5 inclusion and after 25th June. Now coming on to sample ACB ARA calculations. So this is a simple illustrative example of how you calculate the tax cost base for a partnership. So let's say investor A makes a capital contribution of 100,000 in year one, and this is the breakdown of their income and distributions. So in the first year, the partnership earned $10,000. Second year, it earned 15,000. Carrying charges basically means all interest expense or other expenses expenses incurred by the partnership. So for the first year, it was $2,000, which is standard for both the years. The partnership also earned capital gains income of $5,000 for the year and 10,000 in year two. And the cash distribution means the amount which was distributed or withdrawn by the partners from the partnership. So that is around $7,000 for the first year and $20,000 for year two. So now coming on to ACB calculation. So the first year, the contribution of $100,000 is made, and there was distributions that were made during the year of $7,000. So your cost base for the partnership is 93,000, but for your at-risk amount, which is the maximum amount of loss which the partner can bear, it will also include your ACB and your current year incomes and capital gains. So your at-risk amount would be 93,000, which is your ACB, plus the incomes that were earned during the year. For the second year, you start with your opening ACB, which is your cost base for the previous year. You need to add your prior year's business income and expenses, and you have to reduce the distributions for the current year. So that would give you the cost base for the second year. But from an ARA perspective, which is the at-risk amount, you start with your ending ACB and you add your current year business income and capital gains. So that will give you the amount of at-risk amount calculated for the year two. So these slides, provide you with a basic example while you're calculating the adjusted cost base and at-risk amount for the various partnerships which you're working on. So due to complexities in tracking the ACB for partnerships, if any investor is invested in a partnership, it's very difficult for any advisor or brokers to calculate the ACBs. So that's where a tax consultant using these calculation mechanisms can play important role in factoring the overall tax computation. Now coming on to a sample ACB ARA calculations for trusts. So for a trust, it's relatively simple. I mean, any investments that you make becomes the cost of the trust, but any distributions that are made is a grind down or a reduction in the value of the investment in the trust. So following a similar example, you have business income, 5,000, 10,000, you have capital gains of 3,000, 6,000, return of capital, and you have cash distributions. So for the first year, the contribution becomes the value of the investment, and any return of capital or distribution reduces the value of your ACB. And in the second year, you follow a similar method. So any distributions made to the investors reported as a return of capital will reduce the value for the trust. Now coming on to the final leg of the discussion, which is the alternate minimum tax rules for 2024. So alternate minimum tax, it applies to individuals and trusts. It is a secondary method. So uh, the principle of how alternate minimum tax works is that you calculate your income and tax liability as per the standard provisions. At the same time, you also calculate what is the minimum tax the individual has to pay as per the AMT provisions. If the AMT is higher than the normal tax, you pay the alternate minimum tax liability, but the difference between the AMT and actual tax liability would be allowed to be carried forward and would be allowed to be credited once your actual tax liability becomes higher than the AMT. So for calculating the AMT, there is a separate base which is different from calculating the standard rates. So while calculating alternate minimum tax, you have to consider your capital gains at 100%. So while calculating tax under normal rates, you only consider 50% of the gains as taxable. But for calculating AMT, 100% of the gains is considered to be taxable. While you're setting off losses, you're allowed to set off only 50% of the loss carry forwards for AMT. Whereas for actual regulation, you are allowed to deduct 100% of capital losses. And for interest and financing expense deductions, you're allowed to only deduct 50% of that expense for AMT. Whereas for other regulations, you are allowed to deduct at 100%. The AMT tax is calculated at a 20.5% tax rate. The following trusts are specifically excluded. So as I said, AMT is applicable to trusts and individuals. At individual level, AMT is not applicable if the income is below 173K. If it exceeds beyond that level is when you have to do a parallel AMT calculation. But from a trust standpoint, there are certain trusts which are excluded, which is any trusts have including RRSP, TFSA, FHSA plans. A mutual fund trust is excluded from AMT. Similarly, a graduated real estate is excluded from AMT. So with this, it was a pretty, short and crisp discussion, considering that we are only touching the basis of these tax implications, because there are many layers of tax complexities which are involved in here. But if you guys have any questions, feel free to ask. And okay, yeah. So thank you everyone.
Thank you, Azhar. Thank you, everyone. Thank all participants.